If you're a dividend growth investor who believes in the wisdom of Warren Buffett when he said, you need to be greedy when others are fearful and fearful when others are greedy, and you're looking for a reasonably high current yield and good long-term dividend growth, then you might want to take a closer look at State Street Corp, one of the higher quality asset management companies in the country. Hello, everybody. This is Chuck Carnevale, co-founder of Fast Graphs, the fundamentals analyzer software tool, aka Mr. Valuation. And, one of the things that has been happening here, we're all concerned about the bear market that's basically unfolding before our very eyes, and there's reason to be concerned, especially if you have been participating in some of the really highly overvalued stocks that this market has been giving us over the last 3, 4, 5 years or so. But if you're a value investor like yours truly, then I think it's time to really embrace the opportunity that's unfolding before our very eyes. In today's video, I'm going to take a look at the asset management and custody business. I'm going to look at 6 of the highest quality, largest companies in the industry. And I'm going to look at them from the perspective of valuation, potential total return, and current yield. Now, those 6 companies I'm going to be covering are Ameriprise, Bank of New York Mellon, Blackrock, which is the largest, Blackstone, which is the largest alternative asset manager, KKR, and then State Street. And I'm going to be looking at these in the terms, as I mentioned, in the terms of dividend growth and dividend yield and total annualized rate of return potential. If I'm looking for the highest dividend yield, that would be Blackstone. But it doesn't necessarily offer me the highest future total rate of return, and I'll cover that in a moment. So my choice today, the company that I'll be featuring the most, will be State Street. I just believe all of these companies are extremely high quality. They're all A-rated or better. From the lowest quality is A- at Ameriprise. The highest would be AA- with Blackrock. And then, some are A and some are A+. But in terms of future total return, State Street offers the highest future total return, and it also offers us the second highest dividend yield and one of the fastest dividend growth rates of the whole group. So if you'll bear with me, I'm going to do it in alphabetical order as I usually like to do, just because it's simpler. Let's go ahead and take a look at these 6 extremely high quality asset management and custody bank stocks, and you'll see some great similarities between a lot of them. You're also going to see some valuation similarities. And, again, I'll be featuring State Street, which will be the last company I'll be covering in the video. I'm just going to go through these quickly. Ameriprise is one of the faster growing. It's averaged about 12.92%. This was a spinoff from American Express. It's an A- rated company. It's got a market cap of $26.5 billion. Its long-term debt to capital is a manageable 46%. And as you can see, it normally trades between a 13 and a 15 PE ratio. The company is currently undervalued and has very nice growth prospects, offers about a 2.07% earnings yield. Now, I'm going to go through these very quickly and looking at some of the key components because we've added a feature here to Fast Graphs because a lot of these financials don't have the basic pure free cash flow number that we produce for most companies. But we're going to look at free cash flow to equity, and we're going to see Ameriprise covers their dividend with their free cash flow to equity, a good bit of the time. Another valuation reference I want to look at is price to sales. Now, price to sales currently for Ameriprise is a little higher than I would like to see, but otherwise, Ameriprise turns out to be a very good choice here, I think, in today's marketplace. Disclosure, I'm long Ameriprise. The next company on the list, the second company on the list, would be Bank of New York Mellon. Now, Bank of New York Mellon has some very similar characteristics to State Street, and I'll be covering that. I want you to note that during the Great Recession that was financially instituted, these companies did suffer a little bit of earnings weakness, and they did cut their dividend, as you can see by the drop in the white line. But their dividend has grown very nicely since, and the stock is very inexpensive. Currently offers a blended PE of 9.8, so you can buy this for less than 10 times earnings. It offers a very healthy 3.22% dividend yield. And normally, as you can see how consistent This has been about a 15 times earnings-ish company. And again, you can buy it today at 10 times earnings. So it's, tremendously on sale. Looking at some of the other aspects of this company, if you look at the analyst scorecard, I want you to note it has a very clean record. The analysts have missed, coming out of the Great Recession, which was understandable. And, otherwise the analysts have had a pretty good record. If I look at it for the last 10 or 12 years, their record has been very, very good. So, it is a consistent performer. Looking at the company from some of the fundamentals, it's A-rated, only has 23.5% debt to capital. Again, offers a 3.22% dividend yield. Now, from a standpoint of growth potential, I would rate this one also very high with a 35% potential rate of return just below what State Street is offering. So I like this one very much. It's one, if you don't like State Street, you might want to take a closer look at Bank of New York Mellon. The next one on the list would be the largest asset manager in the world, and then, of course, that's Blackrock. And Blackrock has been a very consistent grower. It's grown earnings at 15.69% a year. As you can see, the market has really, been generous with the valuation on this company. It was pretty overvalued last year. It's now come into fair value. So if you're really looking for, it's the highest quality AA- rated of the group here. It's got a very consistent dividend record. The yield is currently 3.2%, which is attractive. The thing that I don't like about the stock, or I shouldn't say I don't like it, but the thing that I'm a little concerned about with this particular stock, the thing I don't like about it is it's trading at fair value. It doesn't really offer me a great margin of safety. It does offer me a 3.2% dividend yield. And it's AA rated with about 18% debt. So there's some very positive things to be said about Blackrock. However, the things that I don't, really like, it's not real cheap. But historically speaking, if I'm using history as any guide, it is on one of the lower sides of its fair valuation. So, the question is, are you interested in buying this now? If you were going to buy it, now would certainly be one of the better times, because the thing about valuation is, when you buy these stocks when they're highly valued, that's where you can get yourself in trouble. When you buy them when they're fairly valued, you position yourself to participate in the growth. The next one I'm going to cover is Blackstone. Blackstone is the largest alternative asset manager. As a result, it's also got one of the most inconsistent operating results of the group. It was extremely highly valued just, about a year ago. It's now coming close to fair value. It offers a dividend yield of 5%, which is very attractive, has a very high payout ratio. But as you can see, they haven't even covered their dividend with earnings in a lot of years. And from a standpoint of, free cash flow to equity, the company hasn't really covered their dividend with the free cash flow. So this is not one that I'm really a big fan of. I don't like the inconsistency. It does have a good dividend, but it's got a very spotty dividend record. But Blackstone is a company that's getting close to coming into fair value, as you can see here by the fast graph here. Next one we're going to look at is KKR. It's another alternative asset manager. Again, very similar in terms of being an inconsistent grower, inconsistent dividend record. It does look like it's really attractively valued. It only offers a 1.35% dividend yield. Can be bought at about 10.5 times blended earnings. It's A-rated, but it does have some of the highest debt here with 69% debt to capital. So it's not one that I would necessarily recommend today. The point is, though, it is relatively inexpensive. And then last but not least, we're going to go to State Street, which is the one that I want to feature here. Now, very similar to Bank of New York Mellon, it has a very similar historical operating history because they work in a lot of the same regard. One of the things that Morningstar has said about both Bank of New York Mellon and State Street is both of these companies should benefit from rising interest rates. They only get about 14% of their revenues from net interest income. And so as interest rates rise, they can get some real benefit there. There are risks in these companies. That's why the price is as low as it is. You can buy this company with an earnings yield of almost 12%. The PE is 8.37 blended PE. It offers a very generous 3.6% dividend yield. And although the company did struggle some during the Great Recession, since that time, if I look at it through the last decade or so, not counting the estimate data here, I'm looking at about 10 years of income here. The performance, because it's undervalued, has underperformed the market, but it has generated more dividend income. But what I really want to point out is the dividend growth rate has been, 14.5% on a compound growth rate and 15.4% on an average growth rate. So if you're looking for, reasonably high yield and fast dividend growth, then I believe this company could really foot the bill. Now, it has an 8.6% earnings growth rate and is trading at about 8.3 times earnings. So that's a very inexpensive stock. Looking at it from the standpoint of its analyst scorecard also, it has a very nice analyst scorecard. It's only had some misses during the Great Recession and COVID. It did have a slight miss. But otherwise, if you look at this company's earnings, they've been very consistent historically for more than the past decade. And you can see their dividend has grown and their payout ratio is very low at about 28%. That's another thing that I really like about this stock. From a standpoint of operating cash flow, they've mostly covered their dividend, although recently they haven't. Looking at it from a standpoint of another valuation metric, even on price to sales, the company looks very, very inexpensive. So I do believe that there's risk here, and that's why the price is so low. But I think that low price mitigates most of the risk. Based on, looking to the future, as I mentioned, it's forecast to continue growing at about 13 or 14%. Now, I do want to point out, you can notice that estimates have been dropping for the last year or so. For 2022, 6 months ago, analysts were forecasting $8.40. Then it did go up to $8.50 3 months ago. But now as we enter this recession, they've dropped that earnings estimate down to about $7.70. But that still gives us plenty of cushion here and a real good margin of safety. But then, the analysts do look for a very strong recovery in 2023 as well as 2024. So, on that basis, this company could generate that 47 or 48% annualized rate of return. If it traded at a normal multiple, which is slightly lower, about just under 13, we still have the potential to earn just under 40% annualized rate of return. So I believe the risk-reward ratio here is really in your favor. Yes, it is down, and that does, give you the opportunity to buy it real cheap. So if you're a long-term investor and you're willing to ignore, maybe some short-term volatility here, I believe this would be a great time to take a position in State Street. You can also look at almost any one of these other asset management companies, maybe with the exclusion of Blackstone and KKR. I'm not real high on those, but if you're looking at, Blackrock, the high quality one, if you're looking at State Street and Bank of New York Mellon, I think they both offer a lot of opportunity. I think Ameriprise is still a very excellent choice here in this market. So, there's a lot to choose from here. My pick would be State Street. I'm looking for it for the highest current yield and the best dividend income. Anyway, this has been Chuck Carnevale, a.k.a. Mr. Valuation. I hope you enjoyed this video. I'm trying to give you now here some ideas on some very inexpensive, good quality dividend growth stocks that you can look at. In the asset management category, sub-industry category, these are clearly the creme de la creme of the group. Now, I did leave out names like T. Rowe Price, which didn't have a credit rating, so it didn't miss the cut. T. Rowe Price also looks, pretty decent, although it does have a bad earnings year currently. But generally, I would consider this the cream of the crop. And coming into a market environment like we're coming into now, I believe safety is one of your most important considerations. If you like the video, give me a like, subscribe to the channel, ring the bell, and take a look at Fast Graphs. What a powerful tool and what a great way to help you make good, long-term, prudent decisions. I don't, as I always like to say, I couldn't even consider investing in stocks without the benefit Fast Graphs gives me. Thanks for watching. Talk to you again real soon.